So tonight, let's talk about just how bad China's economy really is and whether there's any chance it can survive Trump's renewed tariff war. My answer is a clear no. First things first, China's export in April. You might have already heard that last month. China's total exports grew 8% year over year when compared with April last year. And that's according to China's official customs data. It reached 315 billion US dollars, an 8% uptick compared to last April's $292 billion. Well, first of all, Chinese customs data is compiled based on whatever is written on the customs declaration forms. It doesn't care whether those goods were ever received by the importers or counted as real export revenue. So if you loaded a ship with goods and declare them export on the custom forms, the goods don't necessarily reach a destination or are settled in trade. So this is according to China's customs data. The exports to US, it decreased by 21%. It was down from almost $42 billion in April 2024 to now the 33 billion this April. Now, keep in mind, some of these goods were shipped in March and cleared customs in April. So this 21% drop is likely understated due to the timing lag. By May, this drop will likely be even worse. But the drop in exports to the US is picked up by the increase in imports to Southeast Asia and Latin America. This is what Chinese exporters have been doing since Trade War 1.0. In 2024, it's estimated that half of the exports to Southeast Asia and Latin America are transshipments with the ultimate destination of the United States. So if you look at the data in April, exports to Southeast Asian countries is up 21%. And then exports to Latin America is up 18%. So think about it. The Southeast Asian countries and the Latin American countries don't have the purchasing power to absorb that kind of increase. These spikes aren't about real demand, they are about transshipment. In April of last year, if you look at this column, total exports to Southeast Asia and Latin America added up to $71.1 billion, right? So if half of that was destined for the US, and that's around $35.5 billion. And then in April 2025, that number jumped by another 14.2 billion. So now we're looking at nearly $50 billion worth of Chinese goods in April, likely being disguised and rerouted to the US through Southeast Asia and Latin America. In April, the US Customs and Border Protection rolled out a new origin verification system. So to pass inspection, exporters must now submit complete energy consumption records, detailed raw material sourcing documents, and the original purchase invoices, and other things. So, and also the penalties are high. Civil penalties can be up to 4 times the duty, the tariffs, and the criminal penalties are up to 2 years in prison. So even if the Chinese exporters were reckless trying to reroute these goods, that doesn't mean that U.S. importers want to risk, fines or jail terms to help Chinese firms cheat. So that $50 billion in rerouted goods may not get through the customs of destination countries and may not be booked as revenue. If they already made it onto ships, it's likely headed for the ocean and floating somewhere, and some of it may end up dumped into the ocean. So that's why from April to early May, major U.S. ports have gone quiet. Cargo volume at the port of Los Angeles, America's biggest West Coast port, has fallen by 35%. Because if transshipment were actually working, sure, Chinese ships should increase, right? But the Southeast Asian and Latin American ships would flood in, and port traffic should remain stable. The fact that total traffic dropped sharply proves that the transshipment didn't get through. So, what's the final conclusion? The 8% export growth, quote unquote growth, that China reported for April is just a mirage based on a pile of fake numbers, covering up a harsh reality. And the numbers for May may look even worse. All right, so that's some numbers on China's exports, but I think what's more interesting is China's financial meltdown. And let's talk about the most alarming figure, China's loans to small and micro enterprises. So what is small and micro enterprises? They're called SMEs. Don't be fooled by the names. They refer to businesses that have either 1 to 100 employees or revenues up to 800 million yuan. And they're not small companies. They make up over 90% of all businesses in China, contribute to over 60% of GDP and tax revenue, and provide more than 80% of urban jobs. They're vital to China's economy, but they're also the most vulnerable during downturns or policy shifts. So, according to Chinese media outlets, at the end of March, the outstanding loan balance of SME stood at 35.3 trillion yuan. By the end of April, the number dropped to 34.3 trillion. That's a 1 trillion yuan drop in just 1 month. 1 trillion, not 1 billion, 1 trillion yuan decline in outstanding loans for the SMEs in a single month means that there were no new loans being issued to SMEs, only aggressive repayment. And let's be clear, in the ongoing economic downturn, this wasn't because businesses suddenly decided to pay down their debts out of goodwill. The only logical explanation is this. Under the pressure of the U.S. China tariff standoff, Chinese commercial banks collectively pulled the plug on lending to private, small, or export-oriented businesses. Not only did they stop lending, they also turned around and demanded immediate repayment from these companies. That's the only explanation for this extreme abnormal plunge in lending to small private firms. Let's connect that to the broader credit picture for the first few months of this year. It's shocking. I'm looking directly at the official chart of total financing flows released by the central bank. I retyped everything for you. Let's take a look at the green shaded columns, right? The first column is January. It's chronologically by month. So January, over 7 trillion yuan in new credit. February, it dropped to just over 2 trillion. Well, this is due to the Lunar New Year break. Then March, it rebounded to about 5 trillion. Then came April. It crashed to just a little over 1 trillion yuan. That kind of month-over-month drop is so steep that it defies conventional logic. Now let's drill down into April's components by looking across to the right, across the cream-colored columns. You see the new renminbi loans came in at only 88.4 billion yuan, a fraction of what we saw earlier in the year. And then the rest of the data is equally grim. Foreign currency loans, negative. Entrusted loans and trust loans, negative. Bankers' acceptance, negative. This shows just how violently commercial activities in China have contracted in April, right? April was extremely bad. Now, the only sector that didn't shrink as much was corporate bond issuance, which saw 234 billion yuan in April. That's mostly due to local government financing platforms issuing municipal bonds. It's what you call LGFVs. So again, it's government government financing. And then there's government bond categories. It's central and local governments together borrowed 973 billion yuan. Everything else too small to matter. So what this tells us is brutally simple. By April, China's financial activities had basically come to a halt. Commercial banks were aggressively calling in loans from private businesses. The only entity still able to borrow money from the financial system was the government. Now, let's add April's trade war escalation into the picture. What do we see? The entire financial system abandoned private companies, cutting off credit, aggressively demanding repayments, and driving them toward collapse, all out of fear of the risk of defaults. Let's take a look at one last set of numbers, that is the investment return on debt. How much fixed asset investment is driven by each additional yuan of debt? And if you look at the ratio, in 2015, the figure peaked at 3.6. I highlighted in green, meaning that every yuan of new debt could drive 3.6 yuan of investment. That means for every yuan of new debt, China could create 3.6, or China created 3.6 yuan worth of real investment. So debt fueled real economic growth. But since then, the return has plunged. And as of April 2025, the number is down to just to be under 1. It's 0.9. That means every yuan of new debt now generates less than 1 yuan of real investment. The rest isn't productive. It goes to pay for interest and roll over old debt. It signals some serious problems. Instead of funding new projects, new debt is being used to roll over old debt. And this is a debt spiral. And also, there's a declining efficiency, right? The economy needs more and more debt just to achieve less and less output. And also, most alarmingly, debts are now non-repayable because when the return on debt falls below 1, the system is consuming more than it produces. It means you can't pay back the principal, let alone the interest. Eventually, defaults, bad loans, or financial crisis become inevitable. So this metric shows that China's debt-fueled growth model has broken or is breaking down. Debt is no longer translating into real growth. It's just plugging financial holes because debt is now outpacing productive investment. It's no longer repayable. And that paints a devastating picture, with banks abandoning private businesses and the government as the only borrower left. China's financial and investment engines have lost all momentum. The system is essentially running on fumes. And the entire setup is now very fragile. People say it's a single spark away from breakdown, and it can lead to a liquidity crisis. And the reason is very simple. When exports decline and when private sector was cut off, the entire economic machine stops.